Financial freedom means having money coming in regularly, even if you don't work all the time. To get there, you need assets that generate money for you, enough to cover your living expenses. But which assets can provide us not only with cash flow to pay our expenses, but also protection against market downturns and inflation? In today's video, we're going to cover 5 assets so you can quit your job. Let's get started. Number 1. Startups and growing companies. How many of you have wondered, what if I had invested in Amazon 20 years ago? How much money would I have now? What if I had gotten in early on Uber or Netflix? We can't go back in time and invest in those big companies. But the good news is that new companies are being started all the time and can become equally big. This type of investment can make you a lot of money, but it also involves a lot of risks. Those who invest in these companies usually allocate only a small part of their portfolio to these investments and understand that it is likely these investments will go to zero. But on the other hand, if they invest in the right company, their wealth can skyrocket and take them to new levels of wealth. All these are good investments, but the best investment you can make is in your own education. Real estate can be a great investment for those who are educated, but for those who are not, it can be a disaster. Investing in stocks can be a great way to build wealth in the long term, but without financial knowledge, we can miss out on great opportunities. Investing in our own education is the foundation of the investment and the development of the life we want. Number 2. Dividend-paying stocks. Owning stocks of strong companies can be a way to earn money regularly without having to work for it. These companies share part of their profits with their shareholders through dividends, which are like cash payments. Different companies distribute different amounts in dividends. This is called dividend yield. For example, Apple has a dividend yield of less than 1%, while ExxonMobil has more than 3%. It's a percentage of the stock price. For example, a company with a 3% dividend yield on a $100 stock would pay $3 per year for each share you own. Just remember, dividend yield is only one of the factors to consider when buying a stock. You also want to invest in companies that are financially strong and expected to continue doing well in the future. Making dividends part of our consistent cash flow is a long-term plan unless you have a large capital to invest. Many investors use compound interest and reinvest their dividends to grow their investment over time until they start earning a good amount of money regularly. Although this is a long-term plan, it is a great addition to our cash flow, as this type of income is very passive and is taxed at a lower level than regular income. Number 3. Bonds. Currently, bonds are not seen as great investments because they don't offer good returns and sometimes don't even keep up with inflation. However, there are strategies where bonds can be used as a layer of protection against market downturns, especially when someone is approaching retirement or already retired. Warren Buffett said that if he died before his wife, he instructed his manager to leave her money in a very specific but simple portfolio. Buffett recommended putting 90% of the money in simple index funds like the S&P 500 and the other 10% in bonds. To see how effective this strategy was, finance professor Javier Estrada tested this strategy with historical market data, and to the surprise of many, this simple strategy outperformed much of the expert investment advice for retirement. But Estrada added one additional detail to this strategy to make the most of the protections that bonds can offer in an investment portfolio. You see, no one can predict when the market will crash. We only know that it will happen at some point. So, we need to have a strategy in place, especially if we are already financially free and living off our investments. Estrada says that once someone is retired and withdrawing money from their investment portfolio, it's important to watch how the market is doing. If the market is doing well, withdraw the money from the stock side since that's what is producing the most returns. But if the market is not doing well and is losing money, withdraw your money from the bond side, as bonds tend to increase in value during bear markets. This will allow the stocks to have time to recover in value instead of selling them when they are down. Number 4. Cash flow generating real estate. It is said that real estate is one of the best ways to get rich, and there are good reasons for that. First, real estate tends to appreciate over time. The market value has more than tripled in the last 30 years. Second, a person can own this type of asset without actually having the money to buy it. For example, let's say we buy a house for $200,000. We put down a $40,000 down payment and borrow $160,000 at an interest rate of 2.5% over 30 years. Our expenses, including mortgage payments, interest, insurance, and taxes, add up to $830 per month. This means that with $40,000, or in many cases much less, we can own a $200,000 asset. But let's say renting this house would cost $1,200 per month. After paying the rent and all the bills, we would still have $370 left over each month. This means we would end up with $4,440 per year. The great advantage of real estate is that your asset is being paid for by someone else, allowing you to build equity in your property. The value of your property is increasing year after year, and you are receiving positive cash flow month after month. Not to mention the financial strategies one can use to expand their wealth with real estate. Some investors borrow money from the value their properties have gained to buy even more properties. Number 5. Cash flow generating businesses. There are many businesses that generate a lot of money that are not listed on the New York Stock Exchange. These can be physical businesses like a restaurant, a coffee shop, a franchise, or an ATM network. They can also be online, like an app or a software business. The goal here is to own the business but not operate it. Not everyone can run a business. It takes a very specific set of skills to manage a business successfully. However, many people own businesses, but instead of managing them, they put people in place to operate them in exchange for a good salary or equity in the company. This type of asset tends to have a higher level of difficulty than other forms of investment. This can mean starting a business from scratch and working until it can run on its own, or finding businesses that need investors or partners. You can also buy an existing business or franchise that is already up and running. While this asset has a higher level of difficulty, it can provide many benefits, such as control over cash flow. When you own the business, you have control over how much of the business's profits you can take home. Additionally, as a business owner, you have many tax advantages, such as benefiting from the dividend distribution tax, which is generally lower than regular income tax. Of course, always seek professional advice to know what you can and cannot do with your pre-tax money. Remember, there is no magic formula for financial success, but with planning, patience, and a well-defined strategy, you can achieve your goals. Diversifying your investments and always seeking knowledge are fundamental steps to becoming financially independent. Thank you for watching. If you liked this video, leave a like and let us know what you think in the comments below. Subscribe so you don't miss any content. See you in the next video.